Alrighty. So I think there's a lot of conversation about wraps, right? Owner financing properties, becoming the bank, right? Using subject to or seller financing or whatever your strategy is to acquire, right, the property. That really is irrelevant in this conversation. The ultimate thing is that yes, you can create passive income streams. Like it's actually not as hard as what people make it out to be. But also, there are some things that I think are important to note, and things that I wish I knew before doing my first couple raps that I made mistakes on. So that's what we're going to be talking about today, is like really getting into like the nitty gritty of like how it works. Okay, real quick before we even get started, does everyone know what a rap is, or do we have questions on like what that is specifically? Because I don't want to skip that. I want to make sure. So, in short, before we move on, a wrap is basically you take over a mortgage, let's say subject to, or seller financing, you create some terms, whatever it is. Let's say it's 3% mortgage, $1,000 a month, $100,000 balance on the mortgage. Okay. You sell that property for more money. So a higher mortgage, let's say 150,000 at, let's say, a higher interest rate. So 8%, right? And a higher monthly payment, which would be, let's say, 2,000 a month, right? So that those new terms are wrapped around the old terms. That's why it's called a wrap, right? So they pay you the 2,000 and then you pay the underlying mortgage the 1,000. That's in short how RAP works. Okay. So what here's what kind of we cover today. One is like what is the interest rate that we actually charge on these? And it kind of depends on price point. And then we're also going to talk about like the use of balloons, right? Cutting the period short artificially. Second thing is down payment, like what I actually require in my business before I just like give someone ownership of the property. And then how to vet these buyers. That's an important thing. Third thing is property condition. So like what can we actually sell as is, like versus like what kind of work do we need to do to the property before we can get it sold. Fourth thing is insurance. So like how does insurance actually work? This is a big one I get. People all the time they're like, how does insurance work on sub two? How does insurance work on a wrap? So we're going to talk about that. And then the last thing is taxes, escrow, and servicing the payment. So how do you actually receive the payment? And then when it comes to taxes and insurance, so escrow, right? Do we pay for that? Do we pass that on? Like, do we charge them that? Do they pay it directly? Those kind of questions, right? Because what I don't want is I don't want these nitty gritty questions to keep you all from building the passive income that you want. So let's talk about the interest rate and the loan structure. I think it's best, and this is what I've gotten from a lot of my mentors, is basing your interest rate off of kind of a price point and also based off of the area condition. Those things matter too. But in general, if you have a property that's like 250,000 and below, a lot of times you can charge that 8.9 or even up to 9.9% if you wanted to. Okay. When you're like 250 to 350 range, it's going to be a little bit tougher to get that premium because things start to become a little bit less affordable at that price point. So we tend to kind of see like 7.9 to 8.5% as like a general, like good rule of thumb in that price point. And then when you get to 350 and above, it gets much harder to sell properties owner finance that way. Can anybody tell me like why they think that is? Why would it be harder to sell a property that's $350,000 for the owner finance market? There's probably multiple reasons. Like, can we name one?
Just I mean, the price alone, probably the house is also probably going to be a bigger house. Um,
Yeah.
it's not the market's going to be a lot
Mm.
smaller. Yeah, I'm
Yeah.
sure there's
I
a
think
lot
that's a great
better.
point.
Yeah,
No, I think you hit it on the head. I think Alex makes a good point too. It's because these buyers, the ones that can afford higher, like 400,000 or 500,000, a lot of times they're more likely to probably qualify for traditional bank financing. I think that's a really good point. And also, if you're looking for a down payment, let's call it 10%. The higher you get up in price point, the tougher it's going to be to get that 10% number that you're looking for. Okay. So here's kind of why. Let me put this down a little bit. There it is. So one thing is like what's the length of term when you sell a wrap? Like how long? Some people do like a 15 year, some people do a 30 year, some people do balloons, right? Can anyone explain to me what a balloon is? Does anybody know what a balloon is?
It's me again. I guess
Please.
I guess it's basically a due date from what I understand. Like there's got a
Mhm.
3 year balloon on it, July the 12th, and it's the balance is due on that date.
Yeah. So you could have a term, like a 30-year amortization schedule, like you said,
Hmm.
but there can be a balloon in 10 years, right? So the payment is based off of a 30-year term, but the length of the term is only going to go for 10 years. Yeah. So you nailed it. That's exactly right. So here's the problem for a normal homeowner when it comes to a balloon. Obviously this means what we just talked about, right? It's in and it's due in one like lump sum at the end of the term. And the problem is like some buyers are not going to be in a position where like either A, obviously they're probably going to have the cash, but they may not want to sell the property. They may not be in a position to refinance it, which could be an issue. The main thing for you is that there are a lot of consumer protection laws that make balloons um, to like individuals much riskier because does the average homeowner know like what a balloon is? Like at a deep level, do they really understand that? I, I have a hard time. I mean, most homeowners don't even know what they put down as their down payment 2 years ago. So to assume, and I think if you get in front of a judge and try to argue, oh, it was in the paperwork, it's like that's tough. Now, if you're selling to an LLC or you're selling to a business owner, completely different story. Business owners and LLCs and corporations are seen very differently from like consumers, right? I think everybody can kind of agree on that. Whether that's right or wrong, I don't know, but that's how things are generally seen. So you got to think about that. And you don't want to be stuck in a position where like they're having to refinance or pay you off at a certain time. And then now you have another headache on your plate where you're having to foreclose on them or kick someone else out of the house when like I don't know, it just feels icky to me. So just be careful with balloons is all I'm trying to say. Um, plus, like, would you not want cash flow for like 30 years if you could get it? Like, why shorten it? I don't know. I will say there is room maybe for a prepayment penalty. For, like if someone's going to pay you off early. Generally, I don't put a prepayment penalty. Like if they want to pay me off early, they can. The only time that I've considered putting in a prepayment penalty is whenever there's a low equity position and there's high cash flow. Can anyone tell me why that may change how we do things? Like why would we put a prepayment penalty with those people? Low equity, high cash flow.
Low equity, high cash flow. So in that situation, if they pay it off, you're not going to pocket very much,
Yep.
and you're reliant on the monthly cash flow of this note to really be, the thing that drives value for you. So if they're going to prepay it, then now you're just out all the profit that you had expected to make.
Well said. Perfectly said. That's the value, right? And in this case, the high cash flow, the cash flow amount is the value. Like I'll give you an example. I have one like this right now. One that I'm selling that our note equity position, which I can explain what that means, but our note equity position is like 20,000. So it's not very high. So like if they go to sell, if I sell this property to them on owner financing, and then the next year they go to sell my property or refinance it and they pay me off, I'm gonna make probably a $20,000 check. The problem with that is that the cash flow on this deal is like $1,100 per month. So the question is, would you rather have 20,000 now or 1,100 a month? Right? I think it's a pretty easy answer for most people. Would probably be the 1,100 a month. That would be the smart thing to do because you look at like your return on equity, basically. What's your return on equity? Does anyone know how we can do that calculation?
Is it the you take the monthly cash flow, divide by your equity
Mhm.
position? So in that case, it was $1,100 per month in cash flow, right? And $20,000
Mhm.
equity position, so it'd be whatever 11,000 or 1,100 divided by 20,000 is. A little
Yeah,
less
you
than
would take that
9%.
1100 and you multiply it by 12 to get the annual.
Oh,
And then
I
you would
see.
divide that by, you're right, exactly. But that's like a 66% return.
Yeah.
Do y'all have a place where you can get 66%? I don't know. That's tough. Now, here's the next question. What if the equity position is $100,000 and the monthly cash flow is 700 a month? Do you want them to pay you off then?
Now it's a little more attractive.
I would want them to pay me off. Right. So are there ways to incentivize people to pay you off early? Yes, and making good at some point. Yeah, cool. I just want us to understand like, this concept as we start to build a portfolio of apps. This is going to be important. Next thing, down payment and buyer vetting. So generally, you're wanting 8 to 10% is kind of what I think is a realistic range. Obviously, as price goes up, we talked about this. It's harder to hit that 10%, right? It just becomes less and less affordable. Okay. Now, to me, a strong down payment is the most important thing in finding a good buyer besides like character, right? Because if they're able to save that amount, to me, that's an incredible sign. Like that means like, okay, they're financially responsible enough to save $30,000. That's more than most people, right? Even if some of it was inherited, like in that kind of situation, it's still at least like protection for you if you have to foreclose. At least you got enough up front to be able to pay for those costs. That's something I think about, right? Because what's very tempting is when you're first selling your first wrap, and I was tempted to do this, is like to settle for like $5,000 or $7,000. And like they'll tell you, like, oh, I'll have the rest in a year and I'll pay you off. And it's like you can't buy into these stories. Like you have to go based off of what they have now. Because you will hear the best stories. Like I heard so many stories. And the problem is these people are super excited about buying. Like it's their one opportunity to feel like they can buy a house. They will tell you whatever they can to get into it. I'm telling you. Like I had people be like, get in the car with me. I got like this album I want to play for you. Like they're trying to build like relationships with me. I'm like, what is happening? Like, you know what I mean? So like, and you have to realize they're so excited. You don't want to let them get ahead of themselves financially. You don't want to put them in a bad spot either. Because you know this, when people have their eyes set on something, they get excited, they can forget about all the potential consequences and downside, right? You gotta watch out for that. What I also require before I actually am gonna like give the buyer the deed, I need the down payment. I need 12 months of bank statements. So I want to see like their full bank statement. I want to see everything. So I'm not just asking for their income, right? You are gonna have proof of income. Third thing is I want to make sure their payment or their income is at least 3 times the monthly payment. Those are the three things that are most important to me. Some people check credit. I tend to not really worry about that because it's kind of one of the pitches. It's like, hey, we're not super concerned about your credit. If you want to check that, I think doing a background check is also a good idea. Just making sure they're not some crazy person or criminal. Like that's kind of the main thing. Okay.
Hey, Evan.
Last, yes.
So, can you go back to, yeah, on the 3 times the payment amount, do you allow
Hmm.
them to pull income from other people that might live in the house, or is it just one person?
Mm,
It
that's a
might be a
good
couple of
question.
families. So, it might be grandma, grandpa, and the kid. And so, do you allow
Yes.
all three of them to come in and pull together to make that 3 times the payment?
Mm, that is a good question. I've thought about that because I've had a couple people that have offered things like that,
Yeah,
and I don't know what I think about it. Um, I think I would need to have a stronger down payment to feel good about that. Um, but also, I'm not saying I wouldn't do it. Like, I think if it's like two people, that's different. Like, if they're a couple, of course.
right.
Um, if it's three people, okay, maybe. If it's four people, maybe not. I don't
So, when
know.
you
What do you
say
What do you
like
think?
income to payment ratio, you're kind of looking at husband, wife, the people that are kind of signing
Yeah,
the dotted line, right?
yeah, yeah. You don't want it to be
Be
like husband and
legal.
wife, and you don't want like husband and wife, and then like, oh, and like my like 16-year-old daughter is gonna get a job at Sonic. It's like, you know what I mean? Like, you don't want that.
Yeah, no, I get it. I've
Yeah.
heard a little bit about that stuff. Some of it's in Section
Mhm.
8, some of it's in other type stuff, but
Yeah.
um, there's just so
Mhm.
much creative financing out there right now. I've heard some interesting stories.
Yeah. That's a good. I think it's a good question to ask. something I'm still kind of thinking through, to be honest with you. So thanks for bringing
That's
that up.
okay. I just want to make sure. So basically, the people that are going to sign on the dotted line and be liable for the payment need to
Yeah,
be the only ones going into that calculation.
for sure. And another like thing that I'm starting to consider implementing is like if somebody doesn't have like quite a strong enough down payment, or if someone doesn't have quite a strong enough like income, like they're kind of just borderline. One thing you can consider doing and asking them, what other assets do you have? And putting those assets up as collateral. That's something I've considered doing. Like even if someone has like a $20,000 boat, it's like, all right, put that up as collateral. Like, let's see how serious you are about this.
Oh, yeah. I
You
get
know,
that.
because that'll tell you real quick if they're serious about buying the house. And if someone actually wants the house, they'll do that.
Yeah, and a lot of people have toys. So that's
Yes, for sure. Boat, car, maybe even another property. You just never
yeah.
know. Land. Some people, I've had people be like, oh, I got this land for like $50,000. I've just held on to for years. It's like, oh, okay, let's just do that. Yeah. Yeah.
That's a good
Um,
idea.
it is. It's something to think about, you know, because you're going to run into situations where you like the person, and this is what this screen's about here. It's like the vibe check. It's like you want to make sure that you don't just trust the numbers. Like you need to make sure you actually like this person to some degree, at least in my eyes. And even if you don't like them, you need to make sure that they're reasonable. That's the main thing. It's like when you talk with someone, you can tell if they're reasonable or not, or if their heads just up in the stars. Like, are they super just optimistic about everything? Or because they're trying to win you over, or are they a little more realistic? Like one of the questions I would ask is like, okay, like worst case scenario, you lose your job, you can't make the payments, what do you do next? Like asking them that. And if
Yeah.
their answer is not like, well, I would come to you and like tell you what happened and then like try to create a plan, you know, if they're just like, oh, I just figure it out. It's like that's not a good answer. Like,
Yeah.
what do you mean by figure it out?
Yeah.
Yeah. Because they need to know, like, this is serious to you. Because you have a payment to make. If they don't pay you,
Right.
something to think about. Not free money. Property condition. So generally on a wrap, I'm selling these as is almost every single time. I've sold properties like literally needing $50,000 in work, $100,000 in work. Um, Buyers will do the work themselves if you give them the financing, which you are in this case, right? You're providing such a valuable thing for them that they can't get approved for it. So they're willing to do the extra work most of the time. The only time I would fix it is when there was like a foundation issue, there's an actively leaking roof, there's something like that that can make the house worse if they don't fix it themselves. Okay. Why do we want to do that?
Protect your
Why
investment.
is That's right. The house is your investment. The house is your collateral, right? Well said. So like this could be things like too, like on the first one, the things I would not fix is I would not paint the house. Um, I probably would not um, even redo the carpet. Um, I wouldn't like paint the cabinets. Um, if there's a window shattered, I'd leave it. If there's a door that is missing, I'd leave it. Like things like that. It's like you don't need to fix that. Light fixtures, don't need to worry about it. Like sell this as is, sell it to them at a good price, you know, where it's fair. Like I'm not saying take advantage of people. I am saying though that the problem with a wrap and the reason why you need to sell it as is most of the time is that the more money you put into the property, what happens to your return? Goes down, right? And so your whole value that you bring is in the financing itself, not in the cash that you bring to the deal. You don't want to be the one lending money. You're using the bank's money to lend. That's the difference. So the more money you put into your house, you're essentially lending the money now, right? And you need a return on that. So hopefully that helps. Trust me. Trust me, trust me. I should show y'all pictures. One day I will. I'll show you pictures of like some houses we've sold under finance, and you would be like, what? You sold that as is to someone? And now they're like in great condition. Like they fixed them up and they're like so clean, which also does what to your collateral now?
protects it and makes it more valuable.
Exactly. Yeah. Here's one of the big ones: insurance. So you sell the house. Here's kind of the exact sequence, okay? On a sub two deal specifically, okay? You take over the payments, right? As soon as you have ownership of the house, you're going to get your policy, okay? This first policy, and you may want to screenshot this or whatever. This will be on YouTube, I guess, too. But your policy that you get is going to be you as the primary insured. The seller is going to be the additionally insured, okay? That's what the mortgage company is going to want to see to accept the policy. And the mortgage company is going to be considered the loss payee or the mortgagee, okay? So that's the first policy. Now, you get that accepted. What you're going to do is once you get that accepted and that's being paid now in escrow through the mortgage company, you're going to cancel the seller's old policy at this time because you don't want to have two policies. Okay. So you cancel the seller's old one. Perfect. Now you're done with the first part. Then we're going to market to find our buyer, our under finance buyers, our wrap buyer, right? We sell it. The moment we sell it, we're going to get a new policy for them. Okay. They're going to be the primary insured now. The seller is still going to be the additional insured. The mortgage company is still going to be the loss payee, and they're going to add you as another additionally insured, or sometimes like a second loss payee. Either way, like you're protected as long as you're like additionally insured on there. And then you're going to cancel your old policy that you just created. Does that make sense? That's kind of like the chain. So what questions do we have on this? Any? Because this can get a little complicated, I feel like. And if not, that's okay too. Nada? Sweet. One thing, when you cancel the seller's old policy, you want to make sure that you have the refund check, because there's going to be a refund check for that, right? Because the lender, how escrow works is like they pay it up front. So they pay the policy basically full, right? You're making monthly payments along the way, going into escrow, right? So they're reserving that for like building that back up for the next year. And when you cancel the seller's old policy, there's going to be a refund check. Sometimes that's $2,000. Sometimes it's 500. It depends on like where you are in the year, right? But you want them to send that check to you. And you're going to cash that using your power of attorney, which I can help you with that paperwork. But you can cash that check into your bank account actually. Okay, and there's certain banks that will do it, certain that won't. I have one that will. So if you need help with that, I can help you. It took me a while to find someone actually that would be willing to. And then the other thing is a lot of times you can put that money back into escrow. Because if you don't, what's the problem with that? If you don't put the money back in escrow? This is a big deal. I made this mistake and it like screwed me on my first rack. There's going to be an escrow shortage. So if you don't put the money back in there, basically what happened is the mortgage company has paid for two policies this year. They paid for your policy, and now they paid for the new buyer's policy when that one got accepted. So they have two policies now that they paid for, right? Out of only saving for one. Throughout the year, you're only paying for one policy. So now you're behind. So unless you put this new refund check in there, this is going to be behind, which means your monthly payment's going to be what?
Higher.
Go up. Like I had my payment go up by like $400 or $500 a month.
So do you send it back to the mortgage company then?
That's right.
And the mortgage company, when it sees all of this going on with the insurance and it sees new people being added, they don't question it. They don't like say, hey, the due on clause.
Yeah.
Like I'm an old mortgage auditor, Evan, and I did this 20 years ago, and I'm like, you would think that would spark something.
Yeah. Yeah. And that's why it's important to know like to do this correctly, because it can raise red flags for sure.
Yeah.
And you can't guarantee that it won't. But if you do it right the first time, you run into a lot less issues. And like most of the time, what I'll do is like, you can even call in. Like ideally what you do first is you have your insurance agent, which it's good to have someone that like knows how to do this the right way. And I can connect you to someone if you need that. that can basically send them like the declarations page, which just like has like insured on it instead of like primary and additional. Now, it's not a big deal, like, because most of the people that are like actually looking at these documents are people that like are very like low level hourly like
I know
tasks.
they're just an analyst. They don't really understand all of it.
Yeah, and they're just looking for the name on the mortgage. Like they see it somewhere on it, and they're like, okay, cool, done, on. And that's been my experience. And a lot of times I'll hop on the phone and I'll be like, hey, did y'all get the policy? I'm like, can you look at it real quick? Like, do you see that? And I've even had times where I'm like, they're like, yeah, it looks like it's additional. I'm like, yeah, but you see their name, right? And they're like, yeah. I'm like, okay, so they're insured, they're good. And they're like, okay, cool. So
So
yeah,
then how do you send it back in? Like how do you get it back in?
the refund check.
Yeah, the refund check and make sure it goes back into your escrow account.
There's different ways to do it. Ideally, you just call the mortgage company, just tell them, hey, I would like to, and usually they'll zip out either the shortage, and then they'll give you an option to pay the shortage, either in a lump sum or as a monthly payment over the next 12 months.
Okay.
Yeah, and then you can just send the check in however they want you to.
Okay.
Yeah, this is really good. I wish I had known this earlier because my buyer got very upset. He's like, "Why is my monthly payment going up?" And like, I had to eat the cash flow, and it was brutal. So,
All right.
um, yeah. Um, we don't want two policies. Two policies together is not good because insurance companies are famous for not wanting to pay out claims. So if you have two policies, they're both going to be like, well, I'm not paying it. You already have another policy. So now they're going to fight, and that's not good. So don't do that. Insurance agent, I can connect you with somebody. Here's one of the last things I believe is taxes, escrow, and servicing. So whenever you're selling the house to them and you're giving them like their interest rate, their term, all that kind of stuff, the principal and interest payment is really like the only portion of your total payment that you can actually give them like a precise number on, right? Because that has to do with the term and the interest rate. That's just principal and interest. You can do like an amortization calculator and find that amount real easy. Escrow, on the other hand, is an estimate only. So we never want to tell them your exact PITI, which is your principal, interest, tax, and insurance. Your total payment is going to be X amount. You can't tell them that. Okay. Why can you not tell them that?
Because we won't know, especially with the cost of insurance, or is
Yeah,
it because taxes can also change over time?
that's right. Both things generally go up over time. And insurance is also very like credit dependent as well. I didn't know that until recently.
Whose credit are they going to check? Are they going to check like the end buyer, or are they going to check
Hmm.
like us who's doing the wrap?
They would check the end buyer.
Okay.
So if they have bad credit, sometimes like their insurance policy is pretty high.
But they're responsible for that anyway. They own it, so
That's
they're
right.
responsible for insurance and they're responsible for taxes.
That's right. Why is it important to give them an estimate though?
So if they can budget.
Yeah,
Yeah, so they can set expectations on how much
that's
to spend.
right. Because I've had people that I didn't set good expectations with, and they're like, I'm gonna have a hard time affording this. I didn't know that insurance could be that much. So you always want to get these quotes up front before closing, ideally. Um, when it comes to servicing, like actually receiving the payments automatically, I use Moneylender Pro. That's who basically everyone that I know that like does notes and wraps for a living uses. Their customer service is like top tier. There's a guy named Josh who owns the company, and like I've met him in person. He's like the coolest guy ever, and would highly recommend him. And he'll like hop on the phone with you anytime and email. Like it's just very small company, and like he's just like wants to do a good job. Like it's really cool. So highly recommend them. I don't get any kind of affiliate from them. Um, as far as like a late fee, 10 days is probably usually what I do. As far as like when a payment's considered late, and then I do like a $50 late fee generally. And you have to enforce these. If you don't enforce a late fee, they will be late. You have to like let it sting one time. So highly recommend that. Okay. Um, now we'll just leave it open for Q&A. It could be anything. It could be based on the wraps, questions on that, how to actually build a wrap portfolio, what the income actually looks like anything really you'll have questions about. I just want to kind of leave it open.
Can we go over the escrow part again?
Yeah, for sure.
So yeah, can you just help me like get kind of caught up on why we need to have that. What's the purpose of that account? Just kind of the
Mhm.
fundamentals.
Yeah. So escrow is super complicated to me, actually. This is one of the hardest things for me to understand. And it still is to some degree. So I'm not an expert, but basically an escrow account within the mortgage company, right,
Mhm.
within the underlying mortgage that you're paying, is an account where the lender is trying to basically guess how much the annual taxes and the annual insurance are going to be like the following year. That's my understanding. So they're trying to build reserves for that. So if they think, let's say they think insurance is 1,000 next year and they think taxes is 1,000, so 2,000
Mhm.
total, they're going to bill you every month to try to build up a reserve over 12 months to $2,000 or more. Usually they try to build a little bit more than that because what they don't want to do is like they don't want to be short by the time they're trying to guess this the right amount, right? Because they're paying it for you annually, even
Oh,
though you're paying it monthly.
okay. So I pay the mortgage company, and then they turn around and they pay the taxes and they pay the insurance.
That's right.
Okay,
Yeah,
got
it's billed. They say it's billed through escrow. So when you're
it. I
getting
see.
the insurance policy, you're like, hey, make sure this is billed through escrow. Like, I'm not going to pay this out of pocket, like up
Oh,
front. You bill it through escrow. They'll cover it.
okay.
Yeah.
Is that a
Mhm.
common practice, or can you just pay it direct?
It's very common. Yeah,
Okay.
Well, isn't it required unless you have 20% down from
I
a
believe so.
from a normal lender? So
Yep.
like a regular mortgage company will require it. And
Okay.
yeah,
Mhm. And if you don't, then they will usually put forced place insurance on it,
yeah.
which is more
What kind of
expensive. It's
insurance?
called force place insurance. It's like they're basically saying we're going to require you to have insurance,
Okay.
and it's just expensive.
Yeah.
Like I got forced place insurance one time because like I forgot to do something, and it was like $4,500, and like my normal policy was like 2 grand.
Outrageous.
I was like, this is crazy.
Yeah.
Yeah. So that's
Um,
like kind of what escrow is basically.
okay. So then what
Yeah.
happens then if they like overcharge you? So they, let's say for your example from earlier, they estimate it's going to cost $2,000 for taxes and insurance.
Hmm.
And let's say they bill you 2,400 over the course of the year, but then the
Hmm.
actual amount is only 1,800. Do you get
Hmm.
reimbursed, or how does that work? Or do they just lower it
Julie,
the following year?
do you have a good answer for that, Julie?
Well, do you want to know my opinion?
I
Yes.
would love to hear it.
A personal homeowner, I would never escrow if you can get the 20% down.
Yeah.
Mm.
Yeah, getting
Because
20%
they
down is
take
easier said than
advantage of it, and I've audited those things before, like big insurance, like big mortgage companies. I've audited the escrow balances, and
done.
they always take it more than they need to, and they never refund it. They
Yeah.
might switch it up a little bit because there's always a lag time in between when you pay and when they figure that amount. So they always keep it, and they're just taking it and investing it. That's how they make their money.
That's,
So, to be honest, as a rule of thumb,
yeah.
if you can afford it, don't ever escrow your insurance and taxes.
Yeah.
Wow,
So
I
then,
didn't know that.
okay. So, but they're going to force you to do that unless you can come up with 20% down. So,
Exactly.
okay. So
And
then
you
what
have to pay,
happens though?
if you don't have it, then you have to pay PMI, which is private mortgage
Yeah.
insurance. And that's
Mhm.
really expensive.
Yeah. And so then what happens if like, you're paying down your loan and the house is appreciating in value and now you get to that point where you have 20% equity? Do they take it off at that point? Or do they have to
Pretty much we're going to have to refinance the loan and
refinance? Okay.
redo it all without the PITI. You're just
Okay.
responsible for it. So instead of paying them, you just put it aside in an account, just take it out of your check and put it in a separate account so it's there at the end of the year.
Hmm.
So
And
you have
then,
it to pay.
yeah. And this was all done because there were so many risky mortgages in the early aughts.
It's been that way forever, guys. I
Okay.
mean, I'm sure, I honestly I don't know why it started, but they found another way to make money on people's money.
Yeah, I mean, it'd be one thing if they were like, consistently audited to and forced to like reconcile that balance, but it sounds like that's not the case.
They are
Okay.
forced to reconcile that balance because it's actually a liability on their books because they owe it to somebody, which is
Yeah.
why, as a bank auditor, I would come in and audit those balances.
Hmm.
But I'm just on average, guys, you know, the balance always runs more than what they have to pay out.
Okay.
Mm, good to know.
Interesting. Another thing to be
Yeah,
pondering about.
for sure.
Yep.
What other questions? Anything else on building wraps or like what that looks like?
I
Passive
missed the
income?
beginning, like 5, 6 minutes, so I'm gonna go
Okay.
back and watch the recording. So,
Yeah, I'll post the recording. This is something we're focusing on a lot um this year. Like we have two wraps right now we're trying to sell, maybe a third. And like my goal is to get to like if you do this right, your average cash flow on a wrap, like in the price point of like 250 to 300 range, like that price point. If you get a low rate at let's say 3%,
right.
I mean your average cash flow is going to be ours is like 850 a month roughly per deal. So you think about, okay, you do that. It's like how many of those do you have to do before you could stop working? Like that's the question that I ask. So that's what we're working towards. Like the next 12 months, I'm like, okay, how can I just get there? Because I mean, I was sitting here literally the other day with somebody right across from me that has like 300 plus of these like notes like this. So if you do the math on that, think about how much he's making by he has one part-time assistant.
That's impressive.
Yeah.
So is it like I have so many questions for you, Evan, because I almost did a deal like this down in Florida, and there's one girl
Hmm.
that I know that has an like a strategy to do this. Um,
Okay.
but it's almost like a double wrap. Like she got it from an investor, she wrapped it with her, and then tried to wrap it with me. And
Oh,
it was very convoluted. And the reason I got out of it is because it was a pad split and the repairs weren't. Thank God I had a lawyer and talked to him about it, but the pad split repairs were not permitted.
so you were going to be in third position,
Yes. Well, I
or your
didn't
more your
realize I
mortgage
was
was
going
going
to
to be
be
in
in
third.
third position until I started digging.
Oh wow,
Yeah. But the third position wraps, it is all over in that network.
really?
Yeah.
Yeah, that's intense. That's a lot of people, a lot of moving parts.
Yeah. And I didn't even really understand, like the
Mm.
first person was like the documents weren't really done right either, so that you were had all the visibility to like what was really going on and who actually would should have been like she was getting money paid by the seller, that person was paying this person, that person was paying her, and then I would end up having to pay it. So it's just little nuts. Like how many times can you wrap one property?
Apparently more than once.
Yeah, I know.
At least they were trying to.
I
Mm.
don't know. But anyway, that's why I was very interested when you started doing this. I'm like, I gotta get on here and listen to this.
Yeah, thanks for hopping on. I'll send a recording.
Okay.
And if y'all have other questions throughout the week or whatever, like let me know. And we could talk about anything. It doesn't have to be wraps, but I think it is a good exercise to look at like, okay, if average cash flow is 700 even or 750, think about that realistically. How many do I need to do to either quit my job or how many of these do I need to do to at least cover whatever bills that you want to cover? And
Yep.
then set a goal for yourself to be like, okay, I'm going to do my first wrap this year or next year. Like you don't have to start with 10. Like start with one, do it the right way. Like we can work through it together. And highly recommend it. It's been nothing for me. It's been almost nothing but passive. Like it really has been passive income. Like I'm shocked. I thought it was fake. Like when I heard people say that until I did it, and like it's very passive.
And you just set up all of the payments for that one property through that company that you talked about.
Yeah, Moneylender Pro is the way you receive the payments and you track all your incoming payments, but you still pay the mortgage directly yourself. the step two. Mhm. Yeah. So money lender doesn't do that. You have to do that. But either way, it's the same idea.
Okay.
Yeah. Thank y'all for taking time out of your Thursday to be here with me. It's been fun talking to y'all, and hopefully this was
Yeah.
somewhat helpful, even though it's kind of a more boring, nitty-gritty call. But this would be a good thing to at least like save for when actually you do your first route.
It's really hard to understand, so I'm glad you took the time to do a little deck and go over it.
It is difficult to understand. Ask me how I know. The first time I did it with like no help at all, and I was like so like what am I doing? Yeah,
Yeah.
it took me like 4 months to set up insurance. Like I was like, I didn't know what to do. So yeah, you can always call me. Cody, thanks for being on here too, buddy. I know you're working, so good to see y'all.
Hey guys, take care.
Have a good rest of
Yeah.
your week. Oh yeah,
I,
y'all can hop off.
yeah, I did have like a just totally unrelated question about talking to LLCs who like own single family homes or properties that are facing foreclosure. I'm just curious if that's something that you run into, and if so, how that conversation is different or similar to doing it with just like a regular homeowner, just has their own name on the property. Does that make sense?
Yeah, it does. I haven't been very successful with it. We've had a couple times where like they have an LLC and we'll look up. It's like I think it's called like Open Corporates or like so there's some kind of website like that that you can look up people's LLCs. I'm sure you could find it through like Claude or something. I
Open corporates.
think that's what it's called.
Yeah.
But you can look up on AI and be like, what are the top 3 ways to find someone's LLC? Like people own the LLC. You can even look up on like tnbear.gov or whatever it is. Like,
Yeah. Okay.
but I would like skip trace those people and call them because you never know how big. Like just because I have an LLC, it could be like me,
Yeah.
like being in trouble or whatever. So like it's still like human at the end of the day. So I would kind of treat it the same until like proven otherwise.
Okay. Right on. Thanks.
I'd go for it.
Yeah. Because I see them. I mean, at least like one a day. One of my like foreclosure leads per day is LLC owned. So
Yeah.
yeah, I've been avoiding it just because I've kind of encountered two issues. Like number one, I didn't know how similar it would be to just a regular conversation, and that's probably just me making an excuse. And then number two, not knowing a good way of finding the right person to get in touch with.
Yeah. Yeah. Well, proud of you, dude. You're taking action. So we're
Appreciate
figuring
it.
out one day at a time.
Yep. I really
Love you,
appreciate
man.
all
All right.
the help and advice. Y'all take care.
Dude, you too. All right. Good to see y'all.
Yeah.